Great, hello everyone. I'm Kevin Werbach, also a colleague of Itai's at the Wharton School. Although I'm in the Department of Legal Studies and Business Ethics, I do work on emerging technologies, most recently focusing predominantly on blockchain and cryptocurrencies. And this is the last panel session of the day, so it's going to be somewhat futuristic and forward-looking. We're going to talk in particular about three major technologies that at least are being put forward as being potentially totally transformative and disruptive in financial services as well as other sectors. Those being AI, blockchain and cryptocurrencies, and quantum computing. And as I was talking with the panelists beforehand, I formed the opinion that we should call this panel the good, the bad, and the future. Hopefully the future won't be ugly, but we'll see. So we're going to talk about the potential of these technologies, how real it is, and what they might actually mean. We're going to talk some, I think, about some of the risks and dangers, and then hopefully get into, going forward, what can happen to facilitate the best use of these technologies for financial institutions. And so we're going to do this as a conversation. I'll introduce each of the panelists really briefly, and then we'll get started. So to my left immediately is Michael Perrone, who is AI Partnerships Program Director at the Watson Research Center at IBM. Next to him is Mark Jackson, Scientific Lead for Cambridge Quantum Computing. Hanna, who is now visiting scholar at the NYU Stern School. And finally, Jose Penabad, co-founder and CIO of HCG Fund Management. So Michael, let me start with you. So AI, obviously, machine learning, huge topic of conversation across corporate America and certainly in this industry. I know Governor Brainerd talked some about implications of AI yesterday. I know I wasn't able to be here. I don't think you were here either. But I'd ask you, to talk specifically about the potential of machine learning, in particular for risk management, for the kind of black swan events that may not get caught in the traditional models. What exactly could AI mean?
And thank you very much for the question. Thank you, everybody, for being here. I just want to say I've been doing AI research for about 30 years now, so I can talk in broad brushstrokes about many, many aspects of AI. But the issue that Kevin has just raised is very, very important because risk management is what you guys do, right? You want to be able to understand what those risks are. We all know that AI and machine learning in particular have been very, very successful in the recent past 10, 20 years. And they're growing and the hype is there. Some of the success is there. But there are some things that AI just can't do today, and machine learning in particular cannot do. And this is the issue of black swan events, right? To do something with machine learning, you need a data set. Like Marco was just saying here at the last panel. If you don't have a data set, you can't build a model. So how can you predict a black swan event with machine learning? And the answer is today you can't. But IBM Research, my group is trying to address that issue by building models of the world, logical models, models that represent how things actually interact. So we're not building them on data per se, but rather on people's knowledge of the real world, right? So if interest rates go up, what does that do to unemployment? What does that do to business spending? Things like that. Those relationships are things that people have in their brains, have in their heads, and we try to capture that information to build models. And then by capturing those models, we can reason about the future. And this is really what this new technology is all about. It's trying to allow people to think about what might happen in the context of where we are today. So I think it was Todd Baker earlier today said that he described the legal structures and challenges, and that complexity took him a long time, and I think personally, I still didn't get the totality of it. And the truth is the models that you guys deal with are incredibly complex, and there's really very difficult for any one person to keep it in their head. So what you need to do is be able to focus on what's important. And this comes to an issue that we're all well aware of, which is the notion of data overload, right? If you have too much data, you don't know what to focus on. But there's a flip side to that, which is decision overload. If your system is too complex, you don't know what to decide. And so these technologies that allow you to reason about the future allow you to move from a kind of a reactive posture, oh, some disaster happened, what am I going to do, to a proactive or preemptive posture. What can we plan for this particular eventuality, right? So that's the future that we're looking towards. And I can talk more if you have questions later.
All right, great. Well, let's get a chance for everyone to talk a little about what they're working on, then we'll get back into it. So, Mark, quantum computing is something that obviously has tremendous potential, but at times sounds like science fiction and sounds like a fascinating area of fundamental research. But how far along are we to having real-world applications? In particular, what are some of the impacts likely to be in financial services?
Sure. So first, thank you again for the invitation. It's great to be here. So I've been told that you all have physics degrees, so I can be really technical, right? Okay, good. So you've probably seen headlines about quantum computing, and there's kind of a mix of both fact and hype. So quantum computers were actually thought of about 40 years ago, and at the time it was very much science fiction-y. But about 5 years ago, scientists realized that it actually was feasible and very likely scalable, extremely scalable. And so this is when the private sector got into it. Before, it was just academics and researchers. And so since then, it has attracted enormous interest. There are currently over 80 credible hardware groups building quantum computers. So some of these are giant corporations like IBM and Google and Intel and Microsoft. Some are startups. Some are again, academic groups. It is estimated that about $1 billion a week is spent in the Western Hemisphere on quantum computing. So that's how serious they are about this, for reasons that I'll get to. The US government was a bit slow to catch on, but I'm happy to say that about 2 months ago, they really upped their game. There was a bill passed for the House with bipartisan support, supporting quantum computing research, and then a few days later, the White House held a summit, and they gave about $250 million in funding. So at least this is a good start. So what is all the excitement about? Why is this important, and especially in regard to the financial services industry? So there are a few applications which run so much faster on quantum computers than normal computers that they would have been impossible previously. And we know a few of them already. So these include chemistry, some machine learning applications, which are now quantum machine learning. There are some encryption and security issues, but we're looking for others. So the few that are most relevant to the financial industry are probably encryption and security and machine learning. Encryption security is kind of a double-edged sword. It's both very good at hacking and very good at protecting. And machine learning, it's not just machine learning but faster. We think that there will be incredible advances that weren't even possible before.
Great. And I think we'll get into both sides of that as we go further in the panel, absolutely. So Hanna, blockchain, of course, is the buzzword of buzzwords, probably in the last year or so in technology in general. And there are claims that cryptocurrencies are going to replace traditional fiat currencies, that all of the financial industry is going to get swept away by a more decentralized, blockchain-based alternative. So first of all, give us some context about just what these things are and the difference between blockchain and cryptocurrencies and what's actually happening, and then your take on what's real in some of those predictions.
So thank you very much for having me here. Let me just, before I start answering the question, I'm affiliated both with NYU and Bank of Canada, and what I want to emphasize is whatever I'm going to say here are my own views and not Bank of Canada, otherwise I'm going to get into trouble with all that I'm going to talk about. So first of all, we don't really have a good definition or a commonly agreed definition of what blockchain is. And it doesn't mean that we don't have a definition. We have many definitions. So Kevin has written a book about blockchain, and there is a definition. I have a definition of my papers, and we have different definitions, and there are many, many definitions, and they are not consistent. So why is this the case? What we know very well about is Bitcoin's blockchain. So what Bitcoin's blockchain is a ledger of transactions, a complete ledger of all Bitcoin transactions that are stored in blocks and connected by hash pointers. And this ledger, this blockchain, has properties of being transparent, yet being pseudonymous, so it's not completely clear who is doing the transactions, but all the transactions are seen. It's permissionless, it's decentralized, distributed, and it's immutable for all practical purposes, and it achieves all this without the need for trusted third party. So those are great properties. Now, the misconception is that we have a blockchain that is a technology, and Satoshi Nakamoto, by creating Bitcoin, stuck Bitcoin on top of a blockchain. So now, having all those great properties, we can take the Bitcoin out and use blockchain for other things. And this is not completely true. There isn't a blockchain as technology that is completely independent. Bitcoin's blockchain has these properties because it is an outcome of Bitcoin's protocol. The moment we take Bitcoin out of the blockchain, we may have some of those things, but we don't have all of them. And the question is, what do we call blockchain then? What do we require for blockchain to be called blockchain? Is permission blockchain, where parties need to be vetted to be part of the system, is this a blockchain or not? By some definitions it is, and by some definition it is not. We may have a complete transaction, complete history of transactions, ledger of transaction, that are in blocks and connected by pointers, but they are no longer immutable without trusted third parties. Is this a blockchain or not? Well, technically it is, but this is not what we want to mean by blockchain. So now, having this ambiguity about the term, it is really great for entrepreneurs because we can call almost everything a blockchain. Really low barrier, because we point to one feature that is related to Bitcoin's blockchain, and we say, now we are using blockchain for doing things. And what is great, that many of the applications of blockchain are aiming at digitization of data, at putting data in uniform format, putting this data in one database, and data may be coming from multiple sources, giving different sources access to the database so that we can put the data into the database much more quickly and cheaply, and basically making the systems compatible. So all those things are great. They are, whether they are blockchain or not, it's debatable depending on your definition. For most of those things, we did not need Bitcoin's blockchain. But because we start calling them blockchain, they are much easier to implement because there is much more excitement. So all this hype has this great benefit of making big institutions change big things much more easily. Now, whether blockchain is going to disintermediate and decentralize and democratize everything that we are doing, from financial services to brewing coffee in the morning, not even my idea. I was not so creative. Read it online. Well, let's look at the last technology that promised to completely decentralize, disintermediate, and democratize everything, which was internet. Delivered on many aspects, at the same time created biggest giants and biggest intermediaries that we have seen, bigger than whatever we have seen before. And I think, again, my personal view, not Bank of Canada's, that this is the same, blockchain has the same potential, or whatever we are going to call blockchain, some kind of shared database, distributed databases.
To be centralizing as opposed to decentralizing.
To be both, to be in some aspects decentralization, so decentralized collection of information, because this is what those technologies allow for, is you can collect more information from more places. Now what happens is that you need to deal with this information. You need custody of the information. You need dispute resolution. You need customer service. And this is where there's a role for platform to be custodian of it. Even if it is not changing the information itself, there will be benefit of centralization.
Okay. All right, so let's get the final panelist in here before we go back on all these topics. So Jose, you're our one person from the investment side on the panel. How do you think about these kinds of technologies and their impacts, and try to distill down what they actually mean from an investment perspective?
Absolutely. Well, thanks for having me. Thanks for inviting us. Maybe some context as to why we're here. So I am the Chief Investment Officer of ACG Fund Management. ACG was one of the earliest investors on many of the fintech platforms that have been partnering to originate loans in consumer, small business, real estate, and student lending. And we were one of the earliest investors in the loan platforms dating back to 2012. When we think about the intelligence that's being talked about in this panel, we at heart are very excited because our basic premise is that digitalization will change the debt and investing markets we operate in fundamentally and create concurrent ways of new and exciting investment opportunities that we've seen to date and we think are more to come. But we also think of the new technologies we're talking about today as the newest flavor of an old friend, because intelligence has existed in markets since the inception of markets, going back to the buttonwood tree and the odd lot theory, which was a low form of market intelligence, to today's high point of market intelligence, which is quantitative trading and programmatic trading and algorithmic trading. And it sounds like we have a new wave that we're looking forward to in the next 10 or 20 years impacting markets. So I think the question turns to investors to say, what are we supposed to do with that information? At our firm, one of our core beliefs is foresight, which is not just looking forward to see what's coming, but it's also understanding that there are risks that come with all of these new opportunities we're talking about. I look at today's markets and I liken it a lot to modern day driving. So I'm a big Waze user. The other day I was driving home and I was stuck in a ton of traffic, and Waze all of a sudden rejiggered its math and said, take a left turn into this neighborhood and you're gonna get home 5 minutes faster. Well, it was hilarious as I tried to make the left turn that 4 other people must have gotten the same information ahead of me, and all of a sudden my shortcut just turned into like a 20-minute delay. And I think in markets, we've called that crowded trades. So what we look at today's market and say is it's interesting the intelligence that's brought to market, but it also raises the question of whether or not we have an old phenomenon happening, which is everyone thinks they have their own special set of data, and what they really have is everyone's training on the same data model and reaching the same conclusions and now reaching crowded trades. In respect to what we're talking about today in these technologies, I think from our standpoint, we look at it as very exciting, but there are 2 key issues that we want to hear. Number one is the question of adoption. And I think in all the technologies we're talking about today, the question of broad adoption is a big issue. And specific in the lending side, I think we say the word bank, and a lot of times we jump to the conclusion of the JP Morgans and Goldman Sachs of the world with these large technology departments. But as we well know, a lot of the lending in the United States is happening at small community banks and in small outfits that don't have this technological capability. I mean, some of these folks are still generating their FFIEC reports on green screens. And that's a true statement. I've seen it myself. And the ability to make the technological leap is still a ways away for a number of the people that are offering loans in this country. So we, at our firm, have approached it from the point of view of we have partnered with technology companies that have adopted credit practices and principles that bringing these principles with the technology can move forward and really transform the industry. Whether or not the traditional lenders can, I think is a question of adoption, and I'm not sure they're going to be able to or be able to catch up in time. The second problem that comes is data. I think you've heard all the panelists say it. We look at foresight as not just looking forward, but learning from the experience so that you don't step in the same hole again. And when we look at the world we invest in, we've been promised in my seat many new models, the newest model, thin file, and all the things that could potentially happen with new credit models. And what we always seem to find, asset agnostic, is that the first model always is tough, and the second model always is a revision and takes 3 or 4 iterations to truly train your models, and there is a lot of capital lost and a lot of grinding and gnashing of teeth to get to the point where your models are trained. So from our seat, what we react to is with enthusiasm and excitement, and the question we bring back is data, which is show us that this data has been taken out of the petri dish of the labs in the universities and put in the real world, and that it's actually been through iterations on training. And at that point, we think that there's a room for that to be adopted in an investment philosophy.
Yeah, so if I could comment to that, Jose, very interesting perspective, and I think it's a very realistic perspective. I tend to take the perspective on this of the point of view that Carlota Perez put forward in her book on technology revolutions, that we're kind of just getting out of the proof of concept phase for AI and machine learning, and we have this whole rollout phase that could last decades, right, as it pervades into many, many different aspects, and companies become from what they are today to truly integrating the machine learning. And I believe that that process is going to be long and slow and I hate to say torturous, but there will be challenges. And I think the reason I mention all this is that you, this audience, you need to think about this. How are you going to take advantage of these new technologies very deeply? And you have to experiment. You have to play with things. You have to try things. And some things won't work, and maybe many things won't work. Maybe take up kind of a portfolio view of this. But find those things that do and roll them into your business processes as efficiently as you can.
I'm gonna just add one quick note on that. The most successful model rollouts we've ever been involved in is where we've seen the technology sponsor literally say, we know we're gonna lose money on these models. Like, I'm gonna lose my money on this model. I know I need to train my model. Yeah. I know I'm wrong. It's that intellectual honesty sometimes that's lacking in these processes, which is just because it's the new technology doesn't mean it works out of the box. It actually needs to get taken through the mud a little, needs to be roughed up a bit, it needs to get the real world feel of it. Because otherwise, you go and have an LTCM moment in the 90s where like everyone thought those models were great because they immediately worked and then they blew up the world. Or, you know, 08 VAR models, which were great forever and then they blew up the banking market. So I think there's a patience that has to go and an understanding from the sponsors of these technologies. Yep. That they don't make money out of the box, and they need investment to show return, yep. And that investment means losses sometimes, and what we found is there's a mixed crowd in terms of the receiving of that information of when I underwrote this tech, I thought it was going to work out of the box, yep. And then these things never get a chance to thrive because you didn't underwrite that you're likely going to be in a downtrodden yep. Before you see the results of it.
Yeah, and what this reminds me of is that there's a metaphor for computer science, and today, you know, think of something like Microsoft Word, right? It's an established technology, right, that's used by everybody in this room, but it's a point application, at least initially, right? They make updates periodically. But when it comes to AI and machine learning, you have a much more complex system, and the whole process, the whole thought of a life cycle for AI and for machine learning is really in its infancy, and trying to get that capability to take a product or a model from where it is today to where it needs to be tomorrow and the day after, that whole evolution requires continual training. And you're talking about, oh, it's painful to train once. Well, what if you have to do it always? And validation of the data becomes a continuous process. These are the kinds of challenges that we're working with today to solve, right?
Okay, so Hanna and Mark, in terms of the technologies you're looking at, would you say the same thing, that at this stage firms should experiment, have a portfolio, dip their toe in the water? It's enough that they should go forward with that, but not beyond it? Go ahead.
Yeah, so definitely right now it's experimentation, even figuring out whether new technology is actually saving cost. Like, is it really helping? Is it really making the business more efficient? Are we getting something new? But sometimes people say, well, with blockchain you can do the same things that you were doing before, but it's cheaper. Well, it's not clear whether it's cheaper. There are so many ways in which it can be implemented. Like I said, the definitions vary, and then even when we agree on definition, implementations vary, that you need to experiment over and over again before finding a way in which it works for you, and maybe deciding that it doesn't. It doesn't have to. It doesn't have to be, a new technology does not have to be applied everywhere.
Yeah, so in the context of quantum computing, several of the companies building the hardware, such as IBM and Google, they've already developed partnership programs. So they have the computer in their research lab, but they're making it accessible both to the public, in the case of IBM, and then to partnerships, to enterprises, rather, for both of them. And so they're saying, we don't know what this could be good for. We want your ideas on what it could be done with it. The killer app for quantum computers might be developed by a 13-year-old in a garage. And so it's very exciting to see what's happening. And they're spending a lot of time and money getting these ideas back. And so right now, yes, they're losing a lot of money, but it's because they want to see what can be done with it.
But what's the potential there? Why lose that much money
because
with that much uncertainty?
There's a few, we already know of a few applications which would be 1,000,000 times faster on a quantum computer than a normal one. There's things that we could do with it that we never could have before. And so it's well worth a small investment now in the time and effort, because the returns would be so much greater later on.
And if I could comment on that, You're all familiar with Moore's Law and how computers have been getting doubling every it used to be a year, then it was 18 months. Moore's Law is dead. And so the thing is that computers are not going to continue to grow exponentially for much longer. And the question is, what do we do then? And I think quantum computing is one of those answers.
All right, so I said I wanted to talk about the downsides as well. So let me get into some of those kinds of questions. So you already mentioned, Mark, with quantum computing that the ability to solve cryptography problems very quickly is an opportunity, but it potentially breaks so much of the security that we depend on today. So first of all, again, how much should companies today be concerned about encryption being undermined by quantum computing, and then what can actually be done?
Sure. So the reason that you can mostly safely send information on the internet is because you're not sending the information itself. You're sending an encrypted version of that information. And there's a specific mathematical formula that's used for about 99% of online encryption. Unfortunately, that specific formula is very efficiently solved by a quantum computer, meaning they don't need a key or a password to decrypt it. They could actually just do it themselves. And this was realized about 20 years ago, which wasn't such a big deal because there weren't quantum computers yet. But now that they actually exist, people have woken up and they realize this is an issue. It's estimated that in about 5 to 10 years, quantum computers will be powerful enough to do this for the existing standards. So that's the bad news. The good news is they've already begun developing measures against this. So these are encryption methods based on different formula, which are not vulnerable to quantum computers. I wouldn't wait 5 to 10 years before you do anything.
Very good.
Okay, 5 years, it's Wednesday. I'm gonna go install the new encryption software.
Take-home message.
Yeah, that's the take-home message. Don't wait until it's too late, because someone might develop a much faster method, and it won't be that long. But the real issue is it takes time to make this transition in your infrastructure. It takes several years to work out the bugs and things that we talked about. And so you can begin investing in the new generation. It's called post-quantum encryption right now. And you don't need to redo all of your infrastructure. It's actually largely software and a small investment in hardware. This is because all of this new generation of encryption algorithms, they need random numbers. And actually, our company, CQC, has developed the first way of producing random numbers which you can prove that no one has tampered with. So it's not just a matter of, oh, these numbers look random, and I can do statistical tests. You can actually prove using math and physics that no one else has tampered with it. So it really is unhackable. So there are things that can be done right now to protect against hacking in the future.
This sounds kind of like a Y2K kind of problem, though. If it's a systemic problem, some firms may move forward quick enough, but is this an area where there's going to need to be regulatory engagement and industry-wide engagement to overcome these problems?
Yes, absolutely. So it's there's this whole new field of these post-quantum encryption algorithms, and so there's a new set of standards that will have to emerge, certifying each one and what you need and stuff. The Y2K, I do remember that, and there was a lot of fear, and then in the end, it turned out not to be sustained. Whereas with quantum computing, unless something really drastically changes, it is estimated that in about 5 years, quantum computers will be powerful enough to do this. So we already know what the program is that quantum computers have to run. We just need to build the hardware to do it, and we're on track to do that.
Okay, so Hanna, I want to ask you the downside questions. You already mentioned one concern that these blockchain-based systems will actually be centralizing rather than decentralizing. Are there other worries about what will happen as, for example, cryptocurrencies become more widely used in the financial system? We've already got institutions, ICE and Fidelity building crypto asset trading platforms. Are there systemic risk concerns or other worries as these things become more widespread?
So I think that if it comes to trading cryptocurrencies, Goldman Sachs are thinking about cryptocurrency trading desk. The responsible institutions are going to approach it as any other volatile asset. And that is, I personally don't see that this is a bigger issue than any other. I mean, there are many volatile assets that are high risk, high reward investment opportunities, and serious investors don't put a lot of their wealth in those assets. So, so in this context, I do not see that there will be a big problem. If there is irresponsible trading, then like with any other irresponsible trading, either you are not accredited institution, or you. I mean, there are rules for responsible investments. So I do not think that that this is going to be a big problem. Whether the cryptocurrencies would be adopted is a big question. Do we need cryptocurrencies to be adopted? And the current cryptocurrencies don't seem to be very appealing to be adopted for currency use. They are mostly used for investment and for trading and for fun, however you want to, or, wherever you get your fun from, risk or returns. We had seen the price increase and then crash, and nothing really happened. So this does not seem to be a big risk. Now the question is about development of digital currencies by different institutions, and saying how we can learn from cryptocurrencies. Can we use this in issuing our own cryptocurrency? So we have seen ICOs. This would be a lot of firms coming up with their own cryptocurrencies and making them obligatory to use on their platforms. We have had this before. Now it has a fancier name. We have had tokens before. Kevin, your previous book about gamification would include those. So this is like really old stuff in a new dressing. So this is not so much threat that I'm seeing. Now, there's an interesting point that was floated before, and now there isn't so much talking about it. How about we put all the Wall Street trading on Bitcoin's blockchain, right? Bitcoin's blockchain has all those properties, right? It's immutable, it's unhackable, for practical purposes, without the trust without any need for trusted third party, and it's permissionless. So how about we just make use of it, not taking Bitcoin out, but putting all the transactions in Bitcoin. Now the thing is, if you start putting so large transactions, and if you, especially if you want to start putting assets from outside of the blockchain on top of the blockchain, now hacking becomes and making fraud on the blockchain becomes far more rewarding. So you need to put much more effort and money in protecting this blockchain. You say, well, Bitcoin's blockchain, no money is put in protecting blockchain. All this mining cost, the energy use equivalent to Denmark use, this is exactly what holds the permissionless blockchain of Bitcoin secure. The amount of energy used is related to the price of the Bitcoin, and it is related to the value of assets that can be stolen from the blockchain. So if we are going to put all the Wall Street Journal on Bitcoin's blockchain, it's going to be so expensive, then it's not clear it would be efficient. The mining costs are the price for the permissionless ledger, and people don't make this connection very readily. They think it's wasted effort, it's wasted energy, and maybe we can have permissionless without mining. So far we can't. We don't have technology for that. So this kind of ideas, I mean, they don't go very far because they quickly reach this argument barrier. But there are ideas like this. It would be dangerous. It would not be safe. Okay.
All right, we could go right ahead. Sure.
Jump in on that to offer like a real world perspective from folks who have tried to invest in assets like crypto. I'd say the one issue we constantly run into is, we're an SEC registered firm, so this is my point in time where I say nothing we're saying here today offers as a solicitation to buy or sell any of our securities. That's from my lawyer. But most importantly, what we've run into is, how do you really know? Like, if the technology works the way it's described, how can you ever run AML or KYC? How do you really know? You really don't, actually. You wake up one day and you see these articles in Bloomberg about how people were using a different coin to mimic their identity and hide it, and then find out that they were actually, Silk Road or basically a Russian operative, or pick whatever bad black hat you'd like to have. And as an investor, there is no upside to justify the end of our investment activity because we're found that we didn't live up to our AML or KYC responsibility, because there's no way we actually know. If blockchain works, it is truly identityless. So you then rely on a third party who's playing the role of either custodian or on-ramp to these platforms, and you trust them to know. Well, do we really know? And I think that is an issue where you cannot answer, and then you ask yourself, well, what if? And there's no answer to the what if. So on that one, that's one issue, real-world issue for us on adoption, is how do we actually get comfortable that these coins are not tied to criminal activity? The second one onto your ledger with Wall Street is, how do you get those 7 banks that were all trying to partner together in 2014 to actually agree on the ledger? Right? Ultimately, it was, the blocks of Citi and Goldman, and then you had JP and others, and they all broke up because they all fought about what does this mean for the ledger. And then I think a number of the banks funded a custodian blockchain startup that's goal is to essentially disrupt DTCC, right? And end custodian, which from our standpoint, we think that blockchain's first stop is, why do we need a third party to say these assets are here and play the role of custody if blockchain exists? If blockchain exists and we all agree, we all know each other, like, the idea of custody is antiquated. It's over because we've all agreed to a trust system inside of a block. But I think the real world problem there is you've got to disrupt a 200-year-old industry and a number of money-making participants in the process who all have to agree to be disrupted at the same time. And I think that is ultimately one of the challenges that'll go to the longer-term adoption when this starts rolling out.
Can I add one?
Go right. Yeah, and I just say we don't have too much time. We're covering a tremendous amount of ground here, and I want to leave a little bit of room for Q&A. I also will say I'm a professor, so I'm not SEC registered, so I can promote what I do. And my book that Hanna mentioned is actually coming out next week. Is called The Blockchain and the New Architecture of Trust. So if you're interested in these questions, I would recommend it to you to get into them. But let me allow the panelists to speak.
The number one question that I'm asked is, and asked by Michael just a few minutes ago, if I had a quantum computer, could I just mine all the Bitcoin? And the answer is no. And that's because the specific way that you mine Bitcoin, the formula, is not something that quantum computers are known to be good at. So no. What is a threat is that the encryption for cryptocurrencies is the standard one, and so it's vulnerable. You could rewrite the signature file. So that's all.
So you don't have to remind that, you don't have to mine the Bitcoin, you can just spend somebody else's Bitcoin
exactly.
with quantum computer.
Cut out the middleman. That's great. Okay.
Better off go to the exchanges. That's
What do you say? All right. Well, let me ask. I want to ask Michael one more question just about the downsides of AI. Then we'll open it up for Q&A. We're going to run a few minutes over the scheduled times. We started late. What about all the dangers we're hearing about AI, the privacy concerns with the use of big data, the bias kinds of issues? I know Governor Brainerd gave the Amazon example with the hiring algorithm that was picking up biases in the training data. How do we get over those kinds of things? It's the same sort of issue to make these technologies trusted.
Yeah, very good question. And I'm going to do a bit of marketing for my company because I believe IBM was the first company to start a group on AI ethics, right? And what it means to have ethics in AI. And we have been doing that for a while. The White House had a big thing 2 years ago where we brought lots of people together to talk about these issues. And there are issues that people worry about, like you mentioned, the trust and data exposure and things like that. These are things that we're going to have to work through one at a time. But there's some that I think are very important, like there was a list, I can't remember off the top of my head, but things like explainability, right? What does a neural net do, right? And coming back to Todd Baker, if you have a very complex system, how do you explain it to somebody? He took a while to do it, and it wasn't too successful for me. But imagine I have a neural network with 1 billion parameters, 1 billion, and those exist today, and they're growing. How do I explain that to anybody in this audience, right? And so there are techniques and there are methods that we're developing to do that, and the industry as a whole. Also, transparency. What does it really mean when someone makes a decision using a neural net? And data privacy, and then fairness, which is a very important issue for machine learning. How can you develop fair systems? And again, I'll put in a plug for IBM. When the fiasco happened online with the system that recognized faces and it recognized African Americans as gorillas, that was very bad. It was completely unexpected. But it's something that IBM's face recognition doesn't have, that problem. We were worried about those kinds of things before, and you need to think about these problems ahead in order to prepare for them. And we're just going to have to work these things through little by little. And but it's going to have to be not individually, but as a group, as an industry, and as a society deciding what we want AI to do for us.
All right, well, let's open it up for Q&A. Really, any of these topics could be the subject of a full-blown panel, but I want to give the audience some time. Go right ahead.
Thank you very much, panelists. And Mark, I think in the game of rock, paper, scissors, you have the laser gun. you beat everybody. But I'm also glad that you answered Michael's question, because I was going to ask you to ask Michael's question. But referring to an article, I guess this was 9 to 12 months ago, in regards to the advancement that China has made in quantum computing.
Yes.
And I think there was a parallel, maybe one of your colleagues in Baltimore at that institution was talking about the societal and economic system in China compared to, you mentioned $1 billion a week in Western Hemisphere in investment, how they're able to, from a governmental standpoint, focus asset, treasure, and people to this issue, whereas we're relying on universities, decentralized Google. Can you comment on that and what that means for the future?
Yeah, so the truth is we don't know what China is doing. It's a big question mark. As far as we know, the government has just written a blank check. Anyone who wants to do quantum research, they will fund it. And
You should get some of that money.
yeah, anyone in China. Thank you, Michael. No, we know that Alibaba has put an 11-qubit computer on the cloud. We know that 2 years ago they launched a satellite which claimed to use, it was a quantum communication satellite. There's skepticism about how well it worked, but they're at least moving in that direction. Yeah, no, it's unfortunately taken the U.S. government a little while to wake up, but we're hopeful now that they do realize this is an issue, that they're going to be more proactive in supporting it.
Okay. Maybe other questions? Oh, yeah. Let's get the microphone over this.
This question of interpretability is really serious, certainly from a regulator's point of view, because as banks begin to use ML and AI, we have to, as regulators, we have to understand what these things are doing. So, what kind of things is IBM doing or the industry to make these quote black boxes unquote more interpretable to human beings?
Yeah, I think I certainly don't know everything that we're doing or everything that the industry is doing, but I can give you a flavor for what people can do. Think about what a doctor does today. A doctor, he says, how are you feeling? What are your symptoms? Get some numbers. And then based on those, we'll say, okay, because the blood pressure is above this, then because of this, and then so it's like a decision tree, right? So that's what doctors do, and they'll describe, your cancer diagnosis based on the decision tree, right? You can take a neural network and do the same kind of thing. They're algorithms for converting a very complex neural network into a tree of decisions. But that tree is going to be, 4,000 steps deep. So what you have to do is have a way of pruning the tree and finding those things that are the most important, and you have to recognize you're going to be throwing away some detail. And I don't know anything better than that, but I'm sure there's smart people out there trying to figure it out. Fundamentally, if it's a hard problem, the answer is hard. That's the way I look at it.
All right. I think with that, because we want to stay relatively on schedule and wind up with lunch, we'll thank the panelists for a great discussion.
Very good. Thank you. You guys have to get together and build a quantum blockchain.
Quantum
That's what
blockchain.
you guys
Someone
have
will.
to do.
Yeah.
There's a lot of work going on there.
Good questions.
Oh, nice.
Chocolate. Thank you so much.
Good. Thank you very much, Halaburda. Hello.
So, as I am the only thing standing between you and lunch, I will be brief.
So there's a
For those of you who don't know me, I'm Bill Spaniel. I'm the head of Bank Supervision, Regulation, and Credit here at the Federal Reserve Philadelphia, and my first task is to thank Jalapa, Rosalind Bennett, Christopher Feeney, Ite Goldstein, Richard Herring, Aaron Klein, and Kevin Werbach for a really tremendous conference with a lot of good ideas. Really appreciate it.
If you guys care about these things, we should.
When Jalapa asked me to do this, I said, you do realize I've been a bank supervisor for the better part of 30 years.
That would be great. Do you have a card?
I do not like location services on my iPhone, and I still write checks to pay my bills. So perhaps I'm not the best person to act as a fintech poster boy. However, I will tell you, as the conference says, there was much promise noted by Governor Brainerd, President Harker, and Chair McWilliams. And truly, there is a lot of promise in this technology to better access, more inclusion, and credit allocation across a broad spectrum of consumers. And there has actually been much success to date, despite the fact of a lack of a sandbox and some updates of regulatory, but there has been much partnership with the financial industry and others to move fintech forward. I would be remiss, however, if I didn't say there are still many questions to be asked, many of which were asked at this conference, and now we've begun the start of the answers. But these questions are important to us as regulators, and it's important to us as the guardians of the safety and soundness of the financial industry. And they include, do consumers have a true understanding of what they're buying into, of what they're giving up, and how their data is being used and will be used? That's an important question for everyone to answer. Is the quality of this data and the algorithms sufficient to make these decisions, which can be very, very important to individual consumers? What are the unintended consequences? What will they be, and how will we resolve them as they occur? Because they will occur, and we need to have a way to make them right or resolve them. And then finally, I think, when is credit really the right answer for individuals? Consumer debt continues to rise. Is credit overnight the best answer for all individuals? And I think AI and machine learning have promised to answer those questions as well. So again, this has been a great conference with a lot of discussion. It's the second one we've done in Philadelphia. We intend to do more to continue. But again, I think the promise is there. We just need to spend time answering some key questions as we move forward. So thank you all for your time and effort over the last day and a half.